Okay, good morning, ladies and gentlemen. My name is Kwame Owino, and on behalf of the Institute of Economic Affairs, I welcome you to our 42nd webinar for the year. The Institute of Economic Affairs is a think tank, and our work is to carry out research and also to use them as platforms for conversations on topical issues affecting Kenya's economy, the region, and globally. Now, the mission of the IEA is to expand public knowledge about topical affairs, but at the same time to provide policy choices which government may consider, all with the aim of enhancing political economic freedoms, which together lead to prosperity. So we are thankful that you're here with us this morning. And today we are discussing the topic of sovereign wealth funds. If you looked at the newspaper or the news items in the last weeks, but especially I think the day before yesterday when the cabinet had a meeting, the question about a sovereign wealth fund and its establishment has been in public focus for a while, with not least the president, but many other people, the cabinet secretary for finance, talking about the need and the intention to form a sovereign wealth fund for Kenya. There's also been circulating a draft law or a draft bill of the sovereign wealth fund, whose contents we shall discuss later in detail. But the point is the government of Kenya is interested in establishing a sovereign wealth fund. Now, this idea has not started, is not a new one. I think the last administration as well started it, or rather advanced a part of it, and part of that was driven by the discovery of very modest recoverable oil reserves in Kenya. And so the idea about a sovereign wealth fund, which is a government investment fund, has been with us for 10 years or so now. So that's the first point. The second point is that the sovereign wealth funds have been a policy boom area in the last 15 or 20 years, even though they're not new. Some of the largest or some of the most known the earliest sovereign wealth fund in our understanding was the Kuwaiti Wealth Fund, formed sometime in 1953, just as soon as that country discovered resources, huge natural resources in crude petroleum. So they're here, but they're mostly investment vehicles owned by governments, and they're used to direct investments to specific areas, and therefore sovereign wealth funds are a form of industrial policy to the extent that industrial policy is the objectives of government about achieving certain goals in sectors. And so the Kenyan Industrial Sovereign Wealth Fund is an idea that's been spoken about a lot. We at that time had certain views, but today it's worthy of examining because there are two areas to it. One, the political economy of a sovereign wealth fund is something we're going to discuss, but one of the things about it is that there's a strong preference among most governments to have sovereign wealth funds. So we're going to examine in Kenya whether Kenya does need a sovereign wealth fund, and we're going to examine the economics part of it. What are the pre-qualifications for a sovereign wealth fund that will be successful and not necessarily just a sovereign wealth fund by name? And today we have my two colleagues from the Popular Economics Program. The IES Popular Economics Program is one of our 6. I'll go through that quickly. The Popular Economics Program takes issues in the popular press, examines them, and uses them for expanding public education, but also to harness the voices of Kenyan professionals in topical policy debates. We have an international trade program whose work again is to harness is to examine Kenya's engagement in bilateral, regional, and global trade. And the third is the Constitution, Law, and the Economy program, which is a program that examines the nexus between the Constitution, the rights, the institutions, and the constitutional order, and how that affects prosperity through economic incentives and institutions. Our fourth program is perhaps the one that's most known is the Public Finance Management Program. Here we examine fiscal policy, how government and the institutions of government design and execute taxes, tax collections, and at the same time, how that money is spent. Our fifth program is basically a conceptual program. We call it the Futures Program, and here we use futures methodologies to understand subsectors or possible pathways that Kenya or any sector may undergo. And the final one is economic regulation and competition, and here we're interested in a microeconomics program about competition, knowing that competition is one of the critical things for ensuring prosperity, because competition allows for innovation, it allows for expansion of employment, and we're examining how, again, policies on competition, allowing private sector competition enables economic growth. So coming back now, my two colleagues who are the co-researchers in the Popular Economics Program, Maureen Barasa, our Program Officer, and Vivian Ochola, an Assistant Program Officer, will take us through this presentation. We ask for your patience. It will take about 35 minutes. And after that, I'll open up for an hour for question and answer. But before we do that, I'd like you to just take this short notice. While the IEA saves, or rather records these conversations entirely for archival purposes, but also for reference by other people who are not able to sit in as we do. So if you have any objection to being recorded, please let us know so that we can cut off that. But otherwise, the purpose of this is entirely for retrieval, which will be placed on the IEA's YouTube page for the reference of other people, and obviously to advance more conversations and expand access to this material. At the same time, we have at the top of your toolbar, the menu bar rather, your chat box, which allows you to send in questions. So you can send in questions as the presentation is taking place. We'll consolidate them and we'll ask at the end of the conversation. At the same time, or your option is also to just wait a little bit. As soon as the 35 minutes are over, we'll open up and you'll be able to raise your hand and ask those questions by your voice. So once again, thank you very much. This is our 42nd webinar and we're glad you're here. So Vivian, both of you have 40 minutes from now to make a presentation, so you can go ahead. My colleague, Vivian, will go first. Vivian Ochola is, as I said, an Assistant Program Officer in our Popular Economics Program.
Okay, thank you very much, Kwame. I'll take you through the first part. Next slide. So this is the outline. We'll define what sovereign wealth fund is, the attributes of a successful sovereign wealth fund and how it is measured. Then we'll also identify some of the global and African experiences with sovereign wealth fund. Then we'll see the proposed Kenyan bill of the sovereign wealth fund, the microeconomic realities and the fitness. Then we'll identify the policy alternatives, trade-offs, then finally do the conclusion and try to answer whether Kenya need a sovereign wealth fund. Now, what is a sovereign wealth fund? So basically, a sovereign wealth fund is just a state-owned investment fund that is normally financed through fiscal surpluses, commodity revenues. So these commodities can be oil, gas, or minerals, and also foreign exchange reserve. So this is according to a research by Saiton. So it states that it is basically an investment or an investment and a saving by the government. Then the common objectives of a sovereign wealth fund are normally there are fiscal stabilization. So people or countries create sovereign wealth funds for fiscal stabilization if the economy is experiencing economic shock. So the funds do help to stabilize the economy. Then they act as a saving for future generations. So some countries do have sovereign wealth fund for a saving for future generation. So remember, because it is funded from commodity revenues, commodities that are depleted over time, so the economies or the countries tend to save those revenues for future generation to benefit from them as well. Then we have strategic or development investment. So some of these funds are used for strategic or development investments. Then for pension and reserve management. So these are basically the four common objectives of sovereign wealth fund: stabilizing the economy for savings for the future generation, for investment within the country, and also for pension and reserve management. Next. Now, let us see how sovereign wealth funds are measured. So it is measured into three categories. We have the shield economies, aggressive growth economies, and strategic reserve economies. So measuring, when we say measuring of sovereign wealth fund, it means, so this basically is a revelation whether the fund is merely a strategic tool or a a strategic tool for the economy, or it is just an effective, it has become effectively a financial shield for a large economy. So it can just be a tool, a strategic tool, or effectively become a financial shield for a large economy. So when it comes to the shield economies, this is where the fund or the sovereign wealth fund is 200, sovereign wealth fund ratio to GDP is more than 200%. So in shield economies, so these are countries like Timor-Leste, we have Kuwait, we have Norway. So those are countries that have shield economies because their funds or their sovereign wealth funds are 200% of GDP. And for these economies, we realize that the fund is so massive that it can generate more annual income than any other sector within the economy. Then we have the second one, which is the aggressive growth. For the aggressive growth, the fund is basically 50 to 100% of the GDP. So for these countries, we realize that the fund is massive engine used to drive the economy. So it is large enough to build, maybe you can use it to build cities, to build industry, but is not yet large enough to replace the economy. So these countries include countries like Saudi Arabia, we have countries like Brunei. So those are countries that whose sovereign wealth fund is 50 to 100% of the total GDP. Then we have the last one is the strategic reserve. So in these economies, their sovereign wealth fund is less than 20% of GDP. So when we say that, for this, we don't mean that it is a small amount. So we realize for this economy, the funds are very huge in dollars, often $1 trillion. But because the economies are also so big, so you find that the fund is just a smaller percentage. So for example, we have countries like China. So in a country like China, you realize that the fund is about 1.3 trillion USD, but it is a very huge amount of money. But when you look at their GDP, the GDP is at 18.5 trillion. So you realize that the fund is only 7.3% of the GDP. So it is a large amount, but it is also a lesser percentage because the economy is so big. So those are some of the measurements of the sovereign wealth fund in different countries. Then when it comes to the attributes of a successful sovereign wealth fund, so there are certain conditions that makes a sovereign wealth fund successful or not. So for the conditions for its success, the country or the economy must have large and volatile resource revenue. So remember, we say that one of the sources of fundings for sovereign wealth fund is commodity revenue or resource revenue. So a country for it to have a successful sovereign wealth fund, it must have a large, not just a small portion, but a large and a volatile. Volatile resource basically implies that this resource changes, the price changes due to shocks or changes in supply and demand. So the commodity must be large and also volatile. So it is affected by changes in supply and demand within the market. Then another condition for successful sovereign wealth fund is persistent fiscal surpluses. So fiscal surpluses is a condition whereby the revenue exceeds the expenditure in a particular economy. So when the revenue exceeds expenditure, so the country will be experiencing surpluses. So some countries use the surpluses, they save them and invest them in the sovereign wealth fund. Then strong institution and investment capacity. So an economy must have a strong institution because these are the institutions that will be able to come up with laws and regulation to ensure that this fund is safe from political influence and it is used according to its purpose. So the institutions must be strong and the country must also have the investment capacity. You cannot just have the money and save it without investing it because the expectation is that the money must have returns towards the end of the year, annually or even after some period of time. Then there should be a clear separation between saving, spending, and politics. So for any sovereign wealth fund to be successful, there must be a clear distinction between what amount is saved, what the government spend, and the politics. It should not be interfered by politicians, and the government should have a clear or a separate expenditure that is not within the sovereign wealth fund, and the savings should also be very clear. So it should have a distinct or it should be distinct. Savings, spending, and the politics should be distinct. So any political interference to the sovereign wealth fund should not be allowed for it to be successful. Now we want to look at the global and African experiences with sovereign wealth fund. What are some of the global experience that Kenya can learn from, and even the African experience, both the countries that have been successful and the countries that has not been successful. Now, let us start with the successful countries. The first country we have is Norway. So Norway funds its sovereign or finance its sovereign wealth fund from massive oil revenue. So, and it also has got strong institution. In fact, statistics or data shows that Norway Wealth Fund is the largest worldwide. It is the largest. It was created in 1990, and it was its first transfer of capital was received in 1996. So it is one of the largest. It has assets under management about 2 trillion USD. That is as of 2024. Then it is comprised of two separate funds. We have the Government Pension Global. So it is invested globally, so it is not affected by domestic shocks. Then when it comes to Government Pension Fund Norway, for this one, it is invested internally or domestically, so it is affected. So while the other is invested globally, it is not affected by the shocks within the domestic, so it is able to thrive globally than one it's invested within. So it has those two categories. So it is one of the largest, and its major finances comes from oil revenue, and it also has strong institutions that ensure that policies are adhered to, and thereby helping the fund to strive. Then we have Singapore. For Singapore, it finances its sovereign wealth fund from disciplined fiscal policy, then strategic investment. So it is non-commodity. So for them, they don't have resources, but they have surpluses. Singapore has got surpluses. It has got disciplined fiscal policy, thereby making it possible to collect more revenue as compared to the expenditure. So the surpluses are used to finance the sovereign wealth fund within Singapore. Then it has two assets. There is one that is called Temasek Holdings that started in 1974, and it has approximately 159 assets holding. Then we have Government of Singapore Investment Corporation. This one started later in 1981 that has got 330 assets holding. So we are able to note some of the characteristics of these successful economies. So for Singapore, we have found out that it has disciplined fiscal policy, and it also has a strategic investment. Let us see the next one. Then we have Botswana. For Botswana, it relies on mineral, that is diamond, rents, and also a conservative government. Its government is so good, and it has also different types of these funds. It has two accounts. We have the account that is owned by the government, which is the account of the government investment account, where the revenues from the diamond rents are invested. Then we have foreign exchange reserve account that is held by the bank. Then it was established under the central bank in 1994. It also generates and maintains the purchasing power of reserve. So besides the sales of diamond rents, Botswana Sovereign Wealth Fund also gets its finances from the foreign reserves that are held by the banks. Next. Then we have China. Remember China, we saw it under a country that had a very large, it has got a very large economy and also a very large sovereign wealth fund. So it is also non-commodity. It gets its fundings, or the sovereign wealth fund is financed through very large reserves and state capacity, and it was started in 2007. So it also operates within two major funds. We have the China Investment Corporation with an assets under management of 1.3 trillion USD. Then we have State Administration of Foreign Exchange that has assets under management of 1.5 trillion. So it is also one of the largest in the world. So it is also non-commodity. China do not have resources that funds this, but they do fund they do finance their sovereign wealth fund through very large reserves, and also they have a very strong state capacity. Next. Now we have seen the 4 successful cases. We have one in Africa and the rest. Then now let us see the failed cases. For the failed cases, they're majorly in Africa, and we are going to see what led to they once had sovereign wealth fund, but they are failed to in this present time simply because of the reasons we are going to see. So we have for the Angola, it has 2 reasons why it failed. Number one, it was a light capture. So we realized that a section of the government, or due to nepotism, the fund was mismanaged and misused, and therefore it ended up failing and not achieving the purpose whereby it was intended to achieve. Then we have Libya. Libya had also a similar problem. There was poor governance and financial loss. So remember, we realized that one of the purpose of this fund, or the reason why countries keep this fund, is for stabilization. So when there's a financial crisis in a given country, and the country is so vulnerable to shock, so they tend to use or to spend this cash. And we are able to note here that for Libya case, other than poor governance that affected the management of the funds, the financial losses lead to the depletion of that fund, and therefore it is a failed case. Then we have Equatorial Guinea that was affected due to opacity and also corruption. So this fund was there, but it wasn't transparent enough to the citizen. So, and it was corrupt to an extent that the fund could not achieve its objective, and also it was looted and it could not really continue as it is expected. So these are some of we find out that what is coming out clearly is the aspect of poor governance and also mismanagement of the fund and the financial losses. So these are some of the factors or the things that affected this country, thereby making their funds not to yield their expected returns. Next. Now let us go narrow it down now to Kenya. When we come to Kenya, we want to analyze the proposed bill 2025 and its component. So we see the first column shows us the category, how the bill is categorized. Then we have the description. So for the category, we'll look at the primary funding sources, what according to the bill, what is the source of the fund. Then the legal ownership, we have the fund management and also the components. So for the primary sources, the bill says that or describes that the sources of the funds will be from petroleum revenues, then mining royalties and the bonuses. Then for the ownership, we have the National Treasury in the trust for the Kenyan citizens. Then for the management, the bill states that it will be managed by the accounts at the Central Bank of Kenya. Then it has got 3 components. The components, we have stabilization component, we have strategic infrastructure investment, then the future generation component. So it has got the 3 components. So when we go back to the first slide, we showed what the components or why people create the foreign wealth fund, what is lacking here is just the pension aspect of it. So it has all the three components: the stabilization, strategic, then the future generation, that is also referred to as Urithi. So after looking at what the bill suggests, so there's an aspect that we wanted to highlight. It is the aspect of the stabilization component. So if you look at the bill, this is a screenshot from the bill. So it says somewhere, if you look under subsection 3, it says that any withdrawal under subsection 1 shall be in accordance with Article 223 of the Constitution. And when you look what Article 223 says, it basically shows, it allows the national government to spend money not yet approved by the parliament in case of an emergency. Then later, within a month or two, the parliament must approve that money. So when you look at this section, so it states that for the stabilization fund, the government is allowed to withdraw the fund and spend it before the parliament approves of it, then it can later approve it. Like when you read, it says, provided that the withdrawal for the purpose of the section 9B shall be after the contingencies fund budgetary provision has been exhausted. So if in case there's an emergency, the bill refers us to Article 223 of the Constitution that gives the government the mandate to withdraw and spend the sovereign wealth fund cash in case of an emergency. So that is just an explanation and the section that speaks about the stabilization fund. So I'll end it at that point and welcome my colleague Maureen to continue with the next part. Thank you.
Thank you, Vivian. So I'll be doing the next section, that is the Kenya's macroeconomic realities. We've looked at the bill and the African and global experiences. So just looking at the fitness test, does Kenya qualify, or rather, is the sovereign wealth fund really necessary for Kenya? Is it needed for Kenyans? So looking at Kenya's resource reality, we see that Kenya is not a major resource-rich economy. First and foremost, mining contributes a very small share of GDP, and we'll see that in the data. And also the reserves are really small. If you look at the data from petroleum, that is from Ghana, and also, yeah, even the other minerals, you can see the reserves are really, really small. So petroleum production is not only uncertain and located, but also the reserves are small. And also resource revenues are volatile due to the price changes, as my colleague Vivian explained before, and also they're limited and highly uncertain. So by basing the sovereign wealth fund solely on natural resources, is it a wise decision that the government is making, or is it just a fund that looks posh, but it serves narrow interests at the end of it all? So next slide. Based on the four metrics, the four preconditions that necessitate successful sovereign wealth fund, we'll be looking at large and volatile resource revenues. And with that, on large and volatile resource revenues, we'll be looking at, we've already explained large in terms of maybe deposits for these resources, and also the volatility in terms of price changes in response to how the global markets work. So chart 1, which shows the contribution of mining to GDP in billions. This chart basically shows the contribution to GDP in billions, as well as the percentage contribution to GDP. And all through, we can see the share of mining enquiry to GDP has consistently been less than 1%. That is shown in the orange line. Then the contribution to GDP, we have the highest at 120 billion. So this basically shows that either the resources are really small, such that for Kenya's mining resources to be competitive in the global markets, the chances are very low. And also, given the volatility, Kenya doesn't experience volatility because of, like I mentioned, the small reserves for its minerals. Then what we have here is still on the first precondition for a successful sovereign wealth fund for large and volatile resource revenues. We have the value of imports and the exports of petroleum products as one of the resources that we are looking at. So we've already looked at the contribution to GDP, which is very small, it's less than 1%. And looking at the value, the orange bar shows the imports, and the navy blue bar shows the exports, which is in billions. Yes. So looking at comparing exports against imports for the petroleum products, you can see the dominant one all across the 5 years that have been compared, 2020 all the way to 2024. We can see that the orange bar is persistently dominant over the other blue bar, which is the imports. So the share of the imports against that of the exports is very small, is very minimal. And if you're basing the sovereign wealth fund on trading resources, I don't know what that means for the 3 different funds that have been set up for the sovereign wealth fund. And judging from this, does Kenya really need a sovereign wealth fund at the moment? So we've looked at the large and volatile resource revenue. That's the reality for Kenya's resource revenues, as well as resource volumes. Then the second metric that we're looking at, that is the persistent surpluses. And when you're talking about the persistent surpluses, previously in other webinars, we've discussed about Kenya having persistent deficits, and you're going to see that. And as one of the preconditions for a successful sovereign wealth fund, it should have persistent surpluses. So does Kenya qualify the fitness test on persistent surpluses? And by persistent surpluses, it means revenues must surpass expenditure. And data here just shows the budget outturn as a share of GDP, and we have the orange curve, that is the expenditure, then the blue one, that is the revenue. And from this, we can already tell that expenditure has consistently surpassed the revenues as a share of GDP. Then we have the dotted line, that is the negative 2% balance threshold, that is the primary balance. Kenya and its peers are supposed to be at least at the 0 to negative 2% primary balance threshold. Then we have the purple line, which shows the primary deficits, and the green line, which shows the fiscal deficits. And the primary deficits and the fiscal deficits have also been consistently rising here, as you can see. And the deficits arise from expenditures consistently surpassing revenues. Deficit is the difference between expenditure and revenue. So we can see here that the fiscal deficit is negative 4.6%, and it's consistently rising, meaning the debt obligation is consistently becoming bigger with the growing deficits. So instead of Kenya having surpluses, consistently has deficits, as data shows here. And when deficits are accumulating over time, we have the issue of public debts. And just as please help me project.
Maureen, your slide is there, slide 19.
Okay. I wasn't seeing it on my end. I can't see it on my end. Next slide, please. Yeah. So we've mentioned the accumulation of deficit over time results in, to finance deficit, the government either has to borrow or tax more. So, when the government needs to borrow, we can see Kenya's public debt stock as a share of GDP here. And the orange bars, that is the domestic debt as a share of GDP. And the green bars, that is the external debt as a share of GDP. And the curve on top, that is total debt as a share of GDP. And the 25-26 numbers, those are just projections. And from this external debt as a share of GDP, used to be persistently high, but now in 2023-24, the debt trajectory as a share of GDP changed, and domestic debt as a share of GDP rose much higher compared to external debt as a share of GDP. And from this, debt is persistently growing. So we'll see whether it's prudent to, or rather wise to save than to repay debts, as Kenya's macroeconomic realities depict, because debt itself is growing. Expenditure is consistently growing. The revenues are too small, and also the resource revenues are also small, as seen in the charts. Next slide, please. So what you have here is the trends in consolidated fund services and debt service as a share of ordinary revenue, and it shows domestic interest and external interest, redemption for domestic debt and external debt, and the total debt, that is the purple line, and the total consolidated fund service, that is the green line. And from this, the total debt as a share of ordinary revenue, that is the purple line, has been rising all through, as well as the total consolidated fund service. And as the total debt as a share of ordinary revenue is rising all through the year, it takes a huge part of the consolidated fund service. And if you can remember, the consolidated fund service is the first charge, that is the mandatory charge for government. So if debt servicing charges and also the debt obligation as a share of ordinary revenue is increasing over the years, the government, much of the government revenue is directed towards debt servicing for both redemption as well as interest. Next slide, please. Yes, the next slide we'll be looking at the interest rates data. Yes, so this is the interest rates data for public debt. And in this case, we're looking at the average domestic interest rates, as well as the average external interest rates, and the total average, that is the green line. And from these interest rates, our argument, sorry, before we go to that, the average interest rates, the total average interest rates are around 7.6%, while the domestic interest rates are at around 12.2%, and the external interest rates for public debt, that is at around 4.3%, while the global interest rates, interest rates are at around 6 to 7%. So would it be wise to invest in a sovereign wealth fund that gives you a return of around 6 to 7%, or a repayment of debt that is at around 12 to 2% on the domestic end, or 7.6% given the inflation rate that is around 5%. So those are challenges that the government needs to put into consideration before investing in a sovereign wealth fund, because evidence shows that it's more meaningful to invest in something that gives you better returns than or maybe repayment of debt than investing in the sovereign wealth fund. Next slide, please. So for the three components of the sovereign wealth fund, we've seen the stabilization fund, we've seen the stabilization fund. Then we have the intergenerational fund, that is the Urithi fund, as the second one. And what you have here, the purpose of the Urithi fund is to secure the generations of the future. So if the government is planning to secure the generation of the future of the, to secure the future of the intergenerational futures, is it, and looking at the macroeconomic realities, that is the summary of headcount poverty measures. Poverty, if we look at the poverty numbers, looking at food poverty, that is 31.7 people are food poor in the country. That translates to 16 million people cannot afford the average calorific content in a day. Then looking at the overall poverty numbers, that is 39.8 people. Sorry, 39.8% of the population, that is 20 million people are overall poor. And for hardcore poverty, that is 3 million people are living in hardcore poverty, that is 7.1%. And looking at all these realities, the bill future generations, that is the Urithi component, assumes that financial saving is the best way to benefit future Kenyans. Yet evidence suggests future Kenyans might benefit more from healthier, educated, and more productive workforce than dividends on bonds and equities. And also, just looking at the intergenerational equity, which might be misinformed according to its framing, the moral appeal of saving for future generations. Of course, that's a powerful thing, and it appeals to many politically and also maybe morally, but evidence challenges the assumption that financial savings are best vehicles for equity across generations in poor or unequal societies. So by saying this, we already have the debt situation. So if you owe someone 100 shillings and maybe you're earning 20 shillings and you decide to save maybe your 15 shillings, which is giving you maybe less returns than maybe investing it in something with better returns, are you better off repaying debts or maybe alleviating the poverty numbers than trying to save in the sovereign wealth fund? So that's the argument here for the Urithi fund. And next slide, please. So we've already looked at the two components, the large and volatile resource revenues, as well as persistent surpluses. And on those, Kenya does not have persistent surpluses, and also its resource revenues and its resource at the same time are uncertain and small. So tied to that, does Kenya face the same risks? We've seen countries like Botswana, Norway, which have better governance and also they have large resources. What risks does Kenya face, or rather, what does Kenya struggle with? Currently, Kenya has negative present value in major infrastructure projects, and this is evident in the investment that was made in the standard gauge railway. It's running losses every day. Then we have the expressway, which is also running losses. We've seen the Isiolo airport and also some projects which are being currently undertaken. That is the Talanta Stadium, which might be a negative present value infrastructure projects. Then we also have Kenya also has high risk debt distress, and the debt situation, the debt obligation, Kenya's debt obligation is at least 70%, more than 70% of GDP. And there's also political pressure on public funds, in which each regime comes up with its own manifesto and how to utilize public funds, or rather invest maybe in these white elephants, or maybe, their own priorities when it comes to expenditure and budgeting. So Kenya is already struggling with this, and there's also the aspect of governance risks, where time and time again, looking at the corruption index, Kenya has sort of been involved in major corruption scandals before. So investing in the sovereign wealth fund, or rather creating the sovereign wealth fund that has been proposed, is it a good thing? And also, will they be abusing Article 223 of the Constitution? So next slide, please. So we've looked at that. Now we'll be looking at the policy alternatives and trade-offs. And these are just some of the recommendations that we got from a paper by the United Nations University Wealth and Development Research. So evidence suggests stronger options may include using windfalls to reduce public debt, because the priority here is a reduction of public debt instead of saving for future generations and trying to push debt to the same future generations. You're making them worse off instead of trying to reduce the debt obligations, and also trying to make the current population better off such that they can save for the future for themselves. Then strengthen budget discipline and fiscal rules. As it is, some of the funds are the mandates are overlapping, because looking at something like the infrastructure fund, which the strategic infrastructure fund, which is being created, and some of these roles already exist in the budget making process. They already exist in the different county functions. So where are we creating the strategic infrastructure fund, or rather the stabilization fund to repay debts? So what Kenya needs at the moment is not creating a sovereign wealth fund, which has like 3 funds, and there's governance risks, as well as the issue of resource revenues are really small. It should rather focus on strengthening budget discipline and fiscal rules. And third is investing in projects with a positive present value. That includes an analysis before the project is started, and also comprehensive research before starting a project, so that there's positive present value and the returns are good in a project, instead of trying to look for something fancy, that is the sovereign wealth fund, to solve possibly non-existent problems. Then using development banks transparently rather than off-budget funds. Given the governance risk that Kenya has, the funds might just be benefiting the elite few in the country, instead of serving its purpose as an infrastructure fund or a stabilization fund, or as an intergenerational fund, the Urithi Fund. Next slide, please. So looking at the realities in conclusion, the realities that exist, the revenues are too small and uncertain from the data on exports and imports, as well as the contribution to GDP, and the opportunity costs are quite high. Instead of investing in something with higher returns, placing money in a sovereign wealth fund means the returns might be politically impressive, but fiscally trivial. And then that in itself would mean maybe repayment of debt has been forgone, construction of maybe a school, a hospital, or something meaningful has been forgone, and also the governance risks are real in Kenya. That is the issue of institutions that are involved, as well as the laws might be good, but also the institutions might be weak. Yes, and just to conclude, sovereign wealth funds are powerful tools in the right context, and they might be well-meaning, but for Kenya, evidence suggests that fiscal discipline beats financial saving. So it's all about going back to the fiscal rules and the fiscal discipline, instead of trying to save while people are starving, people are jobless, and also there's something called the resource curse, whereby most governments tend to overestimate the returns from the resources, or maybe the limits of the resources. So maybe they'll borrow against the resources in the hope that there'll be returns, but eventually it doesn't pay off. And also development beats portfolio returns. Investing in something that generates better returns is better than putting money in maybe an offshore account that faces governance risks. And also institutions matter more than instruments. So the institutions that are involved in fiscal issues, they matter more than instruments such as creating the sovereign wealth fund. Next slide, please. Yeah, so this was our major source for the research on public savings in Africa and do sovereign wealth funds serve development. And there's a statement there that says, however, Africa's low and lower middle income countries have limited managerial and regulatory capacity. It is therefore better to have one truly effective institutions rather than two weaker ones or three weaker ones. Yes, and also they claim that the case for Africa's sovereign wealth fund, the case for intergenerational sovereign wealth funds in Africa is weak, according to research. So with all this, do you think Kenya needs a sovereign wealth fund? Yeah, that's the end of my presentation. Thank you.
All right. Thanks, Maureen, and thanks, Vivian. Sorry, they took much more time than we anticipated. So I'll summarize in just 3 points. One, the sovereign wealth funds basically are investment vehicles by governments, and they pursue a number of objectives. There's a stabilization function, there's an intergenerational equity function, and obviously there's a stabilization function, the intergenerational equity function, and infrastructure functions. My colleagues also mentioned that a fourth one would be basically pensions management, but because we have an NSSF or equivalent pensions law in Kenya, so obviously in Kenya's case, this wouldn't be the primary purpose. So that's one. Two, they also stated that more than 100 countries in the world have sovereign wealth funds of one kind or the other, performing one or multiple of these functions that we mentioned. So sovereign wealth fund by itself is not a unique thing. And the reason I think this is worth emphasizing is because when you hear the advisors to the president himself, and I've just seen a tweet from including people from the cabinet secretary for interior, talking about a sovereign wealth fund and infrastructure fund. You wonder why that should not be left to the cabinet secretary to persuade us that it's a big and interesting new undertaking. New way of hastening development. They speak about it as if Kenya is one of the few countries that's going to do something really magical. And yet, as you know, in 1953, Kuwait established the first one. We're talking about Singapore. Singapore established most of the funds in the mid-70s and, of course, in the late 80s, well after its independence and when the countries were largely already rich countries. So that's the other thing. Most of them are capitalized with money that comes from either trade surpluses on one side or on the other, huge revenues that come from natural resource rents or natural resource sales. They have persistent in the countries that have them, successful ones. As we said, there are 100 and more sovereign wealth funds out there. And the ones that we hear most about are those that definitely are successful. On the African continent, it's a very, very mixed basket case. Many of them are actually doing very, very poorly. But the boom for their establishment started with the oil, natural resource boom that happened in the mid-2010s, thereabouts. High growth in China, growing countries all over. Oil prices started to go up and natural resources were in demand. Many countries had surpluses that they did now. 10, 15 years later, most of those surpluses have come to, actually some of them are almost negative. Some of them have become completely non-transparent, so nobody knows what's happening. And in the case of Equatorial Guinea, my colleague read it as Guinea, I think it's Guinea. And in the case of Angola, there were private accounts for the ruling parties, and in one case, the families of the Dos Santos. They just take money from it and invest it wherever they wanted in here. Emphasizing the fact that without good institutional protections and constitutional order, these things could go very wrong. And of course, then we were given the classification, which I found very, very interesting, is that you can classify all the 100 and some of them into three basic areas. So you have the shield economies, and these are countries that tend to have a small population, very huge resource rents, or in cases surpluses. And here we have Timor-Leste. It's a developing country, but it's a country that has the size of the sovereign wealth fund relative to its economy is basically double. It's very, very big because most of the petroleum resources go directly into that fund. So these are called shield economies, where the resources within the fund are more than 200% or more of GDP. That's huge. In some cases, it's 7, as you could see with Singapore, Norway, and all that. They're really, really big, meaning that they're equivalent to 7 years of the annual value addition in the economy. That's really huge. Everybody could take a holiday for 7 years and spend that money, for instance. That's what it suggests. There we have the aggressive growth countries, and here the aggressive growth countries are basically Saudi Arabia and all that. They're growing, but the sovereign wealth funds are in the order of, I think, 200% of GDP or thereabouts. And then we have, no, less than 200%. And thereabouts, and then we have the strategic resource. So these are countries that maintain them mostly as a strategic resource, but they're not the biggest thing. They tend to be 20% of GDP or thereabouts of that holding. So if you think about it in terms of 20% of GDP or thereabouts, in Kenya's case, that should just be the equivalent of 1 year of taxes or thereabouts, right? So saving equivalents to 1 year of taxes. It's not nothing, but regardless. So it's clear to me that this classification shows you where Kenya's could be, or it's important to understand the economics of the sovereign wealth fund before we can come about to the fitness test, which my colleagues put us through. And that fitness test was very, very essential. One, Kenya doesn't have huge reserves, and it showed it, whether surpluses of government, whether it's reserves of surpluses of public spending. We have perennial, for the last 15 years, perennial tax, or rather, perennial budget deficits, fiscal deficits. So that's one. There's no trade surplus for Kenya materially. Actually, imports are 2 times higher than exports. And the third question is Kenya does not have natural resources as a share of GDP is less than 1%. So while the design of the sovereign wealth fund is that it will be funded or it will be capitalized from these, that suggests to us, those conditions suggest to us that it will probably be the third tier, which is not bad as a strategic reserve by itself. I think the governance questions around it still remain. Just today, as the Cabinet Secretary for Interior was talking up the question of the sovereign wealth fund and the infrastructure fund, I looked around and I realized that, the Kenya Development Corporation, which is supposed to be an investor for government and other government industries, right, was unable to recover close to 70%, 2/3 of the income that it had lent out for businesses. So if that is government's record in investment vehicles, why do we think that just because you call it a sovereign wealth fund and you have eloquent people from presidential advisors all the way to the president himself and the cabinet secretary for finance and now the cabinet secretary for interior arguing for what a sovereign wealth fund is, I'm not satisfied or I'm not persuaded that that's enough. And that's part of the reason why we had the test. We looked at the Urithi fund, as my colleagues did, and one of the things that it tells you, so there's the stabilization function. In our view, the stabilization function, yes, there are fluctuations that Kenya suffers from, but basically the macroeconomic stabilization function in Kenya does not qualify because Kenya doesn't have huge resource rents that vary. So the stabilization, whether of the currency, of economic growth and all that is monetary policy questions. So I think we need to ask ourselves whether we think that the central bank has not done a good enough job on that stabilization. I think they have. And so it's superfluous to say that we're trying a stabilization and therefore introducing this. So that's one. Strategic infrastructure investment, my colleague has shown you, this country is full of white elephants. Some are still being made, and we are naming it for leaders. Some are alive, some were passed on. But it doesn't change the fact that if you're building white elephants, you're going to build white elephants. I think some of the roads that you've seen, including the Mau Summit Road and all the other things, the numbers that are being cited to me suggest to me that we're on the expressway again to another white elephant. On the future generations question, my colleague has showed us, it's important to ask ourselves, okay, what does the future look like? Now, Kenya today has 40% of its population living below the poverty line. Now, how do you solve poverty problems? Well, there's a strong moral cause for sharing prosperity with future generations, but as Maureen has argued, that might be a strong sense. But the bigger thing is actually to do the kind of investments that drive people's prosperity today, and what we intend for people to do is to generally generations share prosperity. We don't share poverty. By borrowing money, putting it in an investment fund, and at the same time saying that you're using some of that money to, so basically borrowing money at 12-13% as she showed us, and then putting a little money in an investment fund that earns 6%, and then you claim, because the average sovereign wealth fund produces 6% income over 20 years, 6% annually. It's not little, but if the government of Kenya is borrowing at twice that amount, even if it does the best as the globally, best benchmarked sovereign wealth funds do, it means that you'll still be leaving future generations 6 percentage points poorer and obviously compounded over time. So it looks to me like why they haven't answered on the macroeconomics part, we are not tackling the politics. On the macroeconomics part, the case for a sovereign wealth fund in Kenya looks very weak. And it is confirmed by the paper that Maureen told us later about, which was an examination of sovereign wealth funds, all of them, and the African sovereign wealth funds do very poorly. The only exception is the Pula Fund, which is basically in Botswana. Why? One, it has good democratic credentials. Even with shakeups here and there, it has good democratic credentials. It has a history of public finance management, excellent public finance management. It has a history of fairly clean public sector workers. We cannot say that of Kenya today. And then the final one, it has huge revenues that have come from diamonds, which have been saved in the Pula Fund. And that investment has been done well. So while it's a small country, huge resource environment endowments, those suggest to us that we need to look very, very clearly and debate the question of whether a parliament should authorize the setting up of a sovereign wealth fund. But let me open this up to the conversation so that I and my colleagues don't speak to ourselves. Now, this is what we'll do. I'll look through the chat box. I haven't seen any questions so far, but I hope you can send in any questions through the Q&A. At the same time, on the top of the balance of the menu bar, is basically a floating bar, is a menu that allows you to ask questions. So you can raise your hands, I'll point to you, and I'll ask you, you can ask questions or make general comments, and my two colleagues will respond to that. So let me hope we can open this up now for any questions and answers. Anybody with a question or a response or something that you think we've forgotten that we need to bear in mind, please do that. Please ask. Anyone? Is there a question? No, I haven't seen that. Okay, well, because you haven't asked, I'll ask.
There's a question.
Oh, there's a question already. Yes. So there's a question here from Paul Olunga. Thank you, Paul. You're asking, is a sovereign wealth fund a financing alternative to borrowing? Okay. So Maureen and Vivian could answer that. So let me go in the same order. Vivian, you can go fast, and then Maureen can answer that question as well. Let's hope that a few more questions come in as you answering that. Go ahead, Vivian.
Okay, thank you. My response will be no. Sovereign wealth fund is not an alternative to borrowing, because having looked at the sources of the fund, it is not part of the government expenditure in as much as it is used in stabilizing the economy when there's fluctuation and there's shocks. So it is not an alternative financing other than borrowing. Yeah.
All right, Maureen.
Okay, the sovereign wealth fund. It's not an alternative to borrowing, and I'll just take you back to the definition, which is a state-owned investment fund. It's financed from fiscal surpluses. That is, when revenue surpass expenditure, commodity revenues, and also foreign exchange reserves. So, and okay, I think I mentioned the aspect of borrowing in my presentation, and that was just governments estimating. Okay, it's called pre-resource cash, and that is when governments borrow against the estimated resources for instance, maybe they overestimate maybe petroleum products, or maybe gold deposits, or whatever resource that they decide to overestimate. And we also mentioned the aspect of our resources being limited. So if they overestimate and borrow against that, that's when the debt aspect, the borrowing aspect comes in. But so the sovereign wealth fund is not in any case an alternative to borrowing. It serves its own purposes, but yeah, it's not an alternative. Thanks.
Okay. Yes. So Paul asked a different question again. There is a new trend of borrowing against funds. Is this a real fear, or the draft bill covers that end? Borrowing against, so you mean the securitization, right? You mean what government calls securitization, where it borrows money and places as guarantees income, say, from the Petroleum Development Levy or whatever other taxes are being, levies are being collected. And so borrows and securitizes that fund and uses that to either fund an existing infrastructure project or actually assure borrowers that it shall be paid from that. Okay, Maureen and Vivian, you can answer that question. Any other questions? Let me allow for any other question first. Anyone else? All right, Maureen and Vivian. So this time, Maureen, you can go first.
Okay. In the Sovereign Wealth Fund, the proposed Sovereign Wealth Fund bill for 2025, they've just highlighted the aspect of borrowing and withdrawal, but they've not highlighted the aspect of borrowing against the fund. So unless maybe we research more on that, yeah, but it's not being highlighted in the bill.
Okay, Vivian, please.
Okay, thank you. Allow us look into it, then maybe you'll get the feedback.
Okay, fine. Let's ask the next set of questions. The second one again is on ownership. Paul asks again, I saw the cabinet brief talking about an LLCS, limited liability company. This brings us to the question of governance. Is the sovereign wealth fund safe from this political trend of appointing boards politically? Okay, I think you're talking about the cabinet brief that was issued on Tuesday. Was issued early this week, and in it talks about the cabinet meeting which approved that the infrastructure fund should be converted to a limited liability company. Yes, we still don't know how it will work, but my colleagues can comment on that. And your question is, this brings us to the question of governance. Is the sovereign wealth fund safe from this political trend of appointing boards politically? And then CPA James asks, could the government be ahead of us in that they would capitalize these funds as part of GDP? Has someone checked on that? And then the higher GDP value be used to increase borrowing limits. Okay. Thanks, James, as well. Well, let me ask Maureen and Vivian to respond to the two questions, one from Paul and the other from James. Shall we start with Maureen?
Yeah, sure. On Olunga's question, on ownership, the cabinet brief was talking about an LLC, and it brings us, okay, you're asking whether the appointment of boards will be done politically. Okay, they just mentioned the cabinet secretary will be sort of will be writing to the board, but they've not highlighted how the board will be elected in. So maybe that's together with the previous question, that's something we can research more on, and yeah, we'll share the feedback with you. And James is asking, could the government be ahead of us in that they could capitalize these funds as part of GDP? Has someone checked on that? And then the higher GDP value will be used to increase the borrowing limits. Okay, going back to the purpose of the Sovereign Wealth Fund. Yeah, the common objectives being fiscal stabilization and also, yeah, just the sources from the Sovereign Wealth Fund bill. Yeah, it highlights the sources of the primary funding sources being petroleum revenues and mining royalties and bonuses. And what does data show us in the contribution of mining to GDP? In the contribution of mining to GDP, mining contributes less than 1% of GDP. Okay, it's something that's already happening. So I don't know whether investing, okay, and also the returns, the 6 to 7% returns, and also the Kenya's resource revenues from this, and also the resource deposits themselves are very small. So I'm not really certain how it will increase its contribution to GDP, because as it is, it's less than 1% of GDP. And also in terms of its contribution to GDP in nominal terms, it's less than 1 trillion. Okay, it's barely less than half a trillion. So the quantum is really small. So I don't think it will increase to higher GDP value that will be used to increase the borrowing limit. And data here just shows us that. So yeah, I think that answers the question. Vivian?
Okay, thank you. So I'll start with the question of Paul on ownership. So remember, we argued while we were looking at the presentations. We saw some of the reasons why there were some failures in some countries in their SWF. We find it was because of political interference. So we realized for the bill, we note that though it is established with a board, both government official and independent experts, those are published. But when it comes to being insulated or being separated from political influence, that is not really clear, because I can say that it doesn't fully yet insulate the fund from political influence, because most of the opponents are still made through executive discretion without the independent vetting process. So we realize that for it to be successful, it should not be influenced by by the politicians, or it should not be influenced politically. But it is not yet clear on how it is going to be insulated from that. Then for the second question about could the government be ahead of us in that they could capitalize these funds as part of GDP? For this, what I could say is that, while there's a theoretical risk that the government could try to capitalize it, one thing we need to note is that the bill sets it very distinct as a legal entity. For the Sovereign Wealth Fund, it is a separate legal entity. And the funds, the principal funds, are treated as long-term investment when we refer back to our definition, and also rather than the government revenue. So only returns from the fund will be fed into the budget. So basically, it is not considered as to capitalize the part of GDP. Yeah, thank you.
Okay, we'll take this final sequence of questions. from, I think, somebody who's using a Lenovo machine that is unverified, but he says, thanks for the presentation, and with the comments of government borrowing off the books, leaving very little information coming to the sovereign. How do Kenyans follow up on the health of this fund? So basically the transparency questions around this fund. Any ideas on how my grandmother, if informed of this fund, could be informed about this fund at the touch of a button? Okay, well, it's not, the fund has not been established yet, but I think I'll leave it to my colleagues to respond to your question, Lenovo user. Thank you. And then Paul Odunga comes on with a final question. Is it a question or comment? Remember, capital pools attract rent seeking, and in the hands of a populist regime, we will just be sitting up a savings account in a house without locks. Okay, good comment. Okay, so Maureen and Vivian. So I'll start with Vivian. Please answer those questions and say, make your final comments, unless I see another question, and then we can close. So Maureen responds to the two questions, one of them about the transparency requirements in the law. That's one. And then the second one is basically the risks that setting up a pool of funds generally can encourage pilferage, right, of the funds. So let's have that, and then move, Vivian, in addition to telling us basically not just to document the problems, but actually tell us how we as citizens and sovereigns could work to ensure that if a sovereign fund must be established, that we have adequate safeguards to ensure that it performs the functions for which, or rather raise the prospects that it will be successful. So let's start with Vivian, and then we'll finish up with Maureen. Make your final comments as well. Vivian.
Okay, thank you very much. There's a component we saw. If you look at the Kenya's proposed sovereign finance bill, sovereign fund bill, there is a component of ownership. We saw that it is supposed to be owned by the National Treasury in the trust for Kenyan citizens. So there's the component of citizens to understand and to know what it implies. Then, but for us to ensure transparency, because we also noted some of the failures of sovereign wealth funds are because of lack of transparency, and for us to ensure that some of the proposals could be, there should be a combination of independent transparency should be ensured through a combination of independence, governance, and also legally mandated reporting. So they should be reporting on how the funds are flowing in, what investments. Then there should be also be public disclosure of those investments and also independent audit. So they should not be interfered by political or by politicians. So they should be independent. So those are some of the things that should be considered to ensure that the aspect of trust of citizens be incorporated. Citizens should be able to see the audits, the flows of incomes in that particular fund. Then for my concluding remarks, I'll just say that sovereign wealth fund is not a bad idea. It is a good idea, but now the question is, are we really in that position? It has worked for other countries, and we have seen how it has benefited them and how it has worked for them. But for Kenya, I think we should focus much on fiscal discipline and also solving the current problems instead of focusing in saving for future generation and also saving funds while foregoing other opportunity or foregoing other financial distress that we have as an economy. Because remember, in economics, we say while some funds are being saved, the opportunity cost for using that fund in a particular thing is forgone. So we need to spend, or basically what we need to do is to solve the current issues rather than saving funds that maybe cannot be able to help us in the future. Thank you.
Okay, thank you. Just to highlight a section of the sovereign wealth fund bill on page 5, where they talk about investment of the fund and the different instruments that the instruments that are prohibited and those that qualify. So yeah, I'll just highlight a few. So on the prohibited instruments, that's okay. This is just to show how they're breaking down the fund from the withdrawal, investment, and also spending. So the fund shall not be invested in speculative derivatives, unlisted real estate, private equity, art and commodities, or any other instrument as may be prescribed by the CS from time to time through a notice in the Gazette. So we see here that the Cabinet Secretary is given discretion on the prohibition of instruments to be used, as well as yeah. So if something is published, of course, given that the National Treasury has been entrusted with that role in the fund, and maybe they're investing in the prohibited instruments, and also we have some qualifying instruments that they're allowed to invest in. So for instance, the Urithi component shall be invested in qualifying instruments such as securities issued by a Kenyan issuer, real estate located in Kenya, or funds or companies or similar arrangements, the primary purpose of which are to invest in Kenya, or covered bonds secured with assets mentioned under paragraph A, that is Article 43 of the bill. Then, yeah, it shall not be invested in real estate as well as assets or bonds, and also the assets for the stabilization component shall not be invested in securities listed at the Nairobi Securities Exchange, or covered bonds secured with assets mentioned under paragraph A, that is Article 43. So there are some prohibitions as well as qualifying instruments that are already given in the investment of the fund. So as a citizen, or maybe your grandmother, understanding this bill and its purpose, and the discretion that the Cabinet Secretary has been given, or maybe the instruments in which they can invest in or not, and also data published on the by the National Treasury showing the amount of the fund, the interest rates, and all that. I think it will provide a breakdown of and also the transparency of the fund. And yeah, Olunga talking about the capital pools attracting rent seeking, and in the hands of a populist regime, we may be setting up a savings account in a house without locks. Yeah, I'd like to agree with that, because already looking at the stabilization fund, like Kwame mentioned, it's already a role of the monetary policy, as well as the National Treasury handles that. Then the infrastructure fund is the budget process already has takes care of that. And for the Urithi fund, we have the pension funds already exist, the NSSF. So the overlapping roles, and also the discretion that has been given maybe to the Cabinet Secretary, it creates loops for the House having no laws. And just to conclude, I like to say, we mentioned it's well-intentioned, looking at maybe future generations fund, and also trying to cushion the economy from macroeconomic shocks, as they put it, and also the infrastructure fund. But the realities show that Kenya as a country, first of all, our resource reserves are very small. And secondly, the poverty, having 40% of the population living below the poverty line, as well as the debt distress in the country. I don't think Kenya really needs the sovereign wealth fund at the moment. Maybe fiscal discipline, trying to reduce the debt obligation, trying to counter the poverty numbers, among other things. That is the priority that the government should save on, because trying to invest in prosperity for future generations while the current generations are starving and high unemployment numbers, I don't think it's a wise thing for the government to do. Yeah, thank you. Enjoy your time.
All right. Okay. So let me try and just add a couple of things. Yes, government borrowing, committing funds by capitalizing revenue, say Rural Development Levy and a few other levies that exist, is hidden borrowing, to be honest, because whatever the revenues have been intended for. So if you capitalize the levies from the Rural Development Fund and you start to use it to generate for a PPP project, or you use it to generate to construct something, if it goes wrong, for instance, it means you're just borrowing, but you're borrowing off the books. So that doesn't reduce borrowing. So nevertheless, and it's not going to reduce the size of government, which is what is important here. So that's one. The second is my colleagues start with the view that, yes, we don't question the motives of people in government. So the Sovereign Wealth Fund is probably well intended. I am less gracious. I'm not too sure, especially if you look at which kind of people are trying to drive the Sovereign Wealth Fund and what history they've had in public sector management in Kenya. We have reason to be very, very cautious. Regardless, it might pass through law. And as you realized, the Cabinet Secretary is actually, it's now changed where the infrastructure portion of the Sovereign Wealth Fund is going to become a limited liability company, which is a bit puzzling. So how would government place its own money in a limited liability company? But we'll hear more of it. I mean, this is a government with very creative people, and they've done a lot of very creative things. I mean, with the Hustler Fund, all these other things are anything to go by. I think we're going to hear a little bit more, and we're required to be vigilant and look at it. I mean, assess it dispassionately for what it really means. So that's one of those to consider. The Sovereign Wealth Fund, as was intended, based on the law that my colleagues have discussed with you, is supposed to be a state corporation. In other words, it will be a state corporation, and therefore the Cabinet Secretary would nominate people to sit on as a board. The board would then appoint an executive director or somebody who's basically in charge of doing those investments, and to the extent that it's possible to try and keep an arm's length. But we know about state corporations, and when you have them not necessarily directly reporting, but basically having to work at the behest of the Cabinet Secretary for Finance, you know that government influences, perhaps even political influences, would not be zero. So the history of Kenya's institutional architecture is one of the reasons why we have to be cautious about one fund with huge sums of money being left in the hands of a body and a board. I think because it's a state corporation, obviously, the oversight and obviously the audits would have to be conducted through the Office of the Auditor General. Those audits would make disclosures available, and whether Parliament acts on that or not is a separate matter altogether. But let me close with this. I think we've learned a lot today. One, I think that the bully pulpit that the president has taken and the Cabinet Secretary for Finance, in order with and together with the other colleagues in the public, in the cabinet and also some in Parliament, around what the merits of a Sovereign Wealth Fund are, it's a really, really strong one. They have a really, really big one. And there's an obsession with Singapore. So let's look at Singapore a little bit. My view is that based on what my colleagues have provided about the requirements and the fitness test, the proper fitness test for whether a Sovereign Wealth Fund, even the one that has been designed, whatever configuration is taken would be fit for Kenya, is a very, very low chance. I mean, low chance of success, or actually the requirements and the merits for it just don't fit. It doesn't just pass the smell test. I mean, not just the smell test, but the objective metric test. I also think that there's an aim to actually put, as the president said before the State of the Nation, 5 trillion shillings into a fund to ensure that infrastructure is served. Fine. It's not too large. It would be 30% of Kenya's GDP. And so if you think about 30% of Kenya's GDP, to place it in the strategic asset part, right? Reserve part of the classification, the 3 classifications, which is the shield, the aggressive growth, and obviously the strategic reserve part. And so you could use that so it's possible for that to be, it is possible with huge changes to bring in $5 trillion. I mean, 5 trillion Kenyan shillings in there. But the point for us is that I think, to be honest, the promoters, the PR is ahead of the facts about how Singapore became successful. Singapore is not successful because it has a sovereign wealth fund. As you can remember, the Temasek part of the Singapore's strategic, the sovereign wealth fund was established in 1980, late 1980, I think 1987, when Singapore was by far already a very rich economy. It was already a first world economy. So you cannot then attribute entirely Singapore's success to the existence of a sovereign fund. In fact, what happens is Singapore has a successful sovereign fund because it already had the attributes that we talked about. It had huge surpluses, it has good public sector management, zero corruption, and good institutional architecture. So we, in Kenya, when we argue that the magical portion, the magical jet to receiving, to getting to success will come through the sovereign wealth fund, to pende to sipende, I think we are putting the cart before the horse. And that is what's saying, especially when it's coming from an office no less influential, such as the Cabinet Secretary for Finance, including his boss, the President. And so we say that this is not persuasive. Finally, a sovereign wealth fund is not magical because already 100 countries have it. If you know, Uganda has one. Even Rwanda has a sovereign wealth fund called the Agaciro, which somebody reminded me about today. Looking at those countries and Kenya, fine. They have growth rates around about middle levels, such as Kenya's, sometimes 1 percentage point above Kenya's or so. So there's no magic in that. So if a sovereign wealth fund must be, let's ask ourselves whether the economics is right and try to set that right. So far, we don't think that test is qualified. I think the question about the dominance of the sovereign wealth fund in Kenya's policy discourse today is political success. The economics of it is still wanting. Let's hope we get there. But that stated, today is probably our last webinar for the year. We've had 42. If you've attended any of them, we're very, very thankful. We're glad. It's Christmas season as well. A nice time of the year to be happy. Let's all be happy. All factors considered, it's been a long year, varying levels of challenges which you've overcome. We're very grateful that you've supported the IEAs. Have a Merry Christmas and a Happy New Year, certainly. And let's thank my two colleagues, Vivian and Maureen, who've done a fantastic job bringing this topic to us. And let's hope that you continue to engage with us in the new year. The IEA is an organization of members. If you consider being a member of the Institute of Economic Affairs, please send an email to us. We'd be glad to have you as a member, added to the 140 or so that we have. This presentation will be made available. Given the interest that I've seen so far, we're going to have to write up a policy brief on whether Kenya needs a sovereign wealth fund. Please look up in the press as well. Perhaps late this year or early next year, we'll write an opinion article on our view based on some of the comments we've received today and our dispassionate analysis about whether Kenya requires a sovereign. Ladies and gentlemen, again, I can't be thankful enough. Thank you very much. And thanks to my colleagues who are in the background, making sure that these things happen, Justus, Michelle, Oscar, and all the other colleagues that I see here attending and supporting each other. And for the members of the Institute of Economic Affairs, thank you very much and have, again, a Merry Christmas, Happy New Year, and thanks for being friends of the IEA. Cheers.